The market just gave us a masterclass in human psychology disguised as a week of trading. While everyone else saw chaos, I saw opportunity. Oracle drops 11% on financing concerns, then rockets 7% 2 days later on a TikTok partnership rumor. Micron surges 15% on earnings while the Nasdaq makes new lows. The Fed cuts rates but projects hawkish guidance. Japan raises rates to levels not seen since the Clinton administration. Most traders are confused. I'm not. This is exactly what exploitable markets look like. Here's what really happened this week, and why understanding it gives you an unfair advantage over 90% of market participants who mistake noise for signal. I've spent 15 years studying how human psychology creates systematic market inefficiencies, not as a guru making predictions, but as a systematic observer of behavioral patterns that repeat with clockwork precision. This week of December 16th through 22nd was a textbook example of how fear, greed, and cognitive dissonance create temporary mispricings that disciplined investors can exploit. I'm going to break down exactly what the crowd missed, how the system responded, and what this means for your positioning going forward. 3 layers: human behavior driving the moves, system mechanics amplifying them, and the stoic response that profits from both. Let's start with the human layer, because this is where every exploitable opportunity begins. The AI trade, which had anchored investor conviction for months, suddenly looked fragile when Oracle's data center financing fell through. One headline: 11% decline. This wasn't rational price discovery. This was loss aversion in real time. The crowd had positioned for AI infrastructure growth as a certainty, not a probability. When that certainty got questioned, panic selling took over. But here's what's fascinating. 2 days later, Oracle jumped 7% on TikTok partnership speculation. Same company, same fundamentals, different narrative. The human brain doesn't process information objectively. It processes it emotionally, then rationalizes the emotion as analysis. Meanwhile, the Federal Reserve created textbook cognitive dissonance, cut rates 25 basis points but projected only 1 cut for next year. Dovish action, hawkish guidance. The crowd couldn't reconcile this contradiction, so they did what crowds always do. They oscillated between extremes. Risk on Monday morning, risk off by afternoon. Back to risk on Thursday on cooler inflation data. This is exploitable because human beings are predictably irrational when faced with conflicting information. They don't synthesize, they react. The Japan factor exposed another psychological blind spot. Most retail participants ignored the Bank of Japan raising rates to 0.75%, the highest since 1995, but institutional desks couldn't ignore it. The yen carry trade, a decades-long source of cheap leverage, began unwinding. Bitcoin dropped from 92,000 to 86,000, not because of crypto-specific news, but because leveraged positions funded in yen got liquidated. The crowd treats each market as independent. The system knows they're all connected by liquidity flows and human behavior patterns. Now let's examine how the system responded to these psychological forces, because this is where patterns become predictable. The S&P 500's narrow weekly gain of 0.1% masks the internal chaos. Monday's drop to 6,721 tested the 50-day moving average, a level that both algorithms and discretionary traders monitor religiously. The failure to hold would have triggered systematic selling from trend-following strategies and risk-parity funds. Thursday's reversal on inflation data prevented this cascade, but barely. The Nasdaq's relative outperformance at 0.4% wasn't broad-based strength. It was internal rotation. Oracle and Broadcom sold off on earnings concerns, while Nvidia and Micron rallied on supply-side optimism. The system isn't repricing the entire technology sector. It's differentiating between companies that can demonstrate tangible revenue growth and those riding narrative momentum. Micron's 15% surge after projecting the high-bandwidth memory market will reach $100 billion by 2028 validated the AI infrastructure thesis. But Oracle's decline, despite 14% sales growth, showed the system is no longer tolerant of incremental beats. The bar has been raised. Perfection is now the minimum acceptable standard. The bond market's behavior was most revealing. 10-year Treasury yields rising to 4.15% despite a dovish Fed cut signals the market is pricing in either higher long-term inflation expectations or increased term premium due to fiscal concerns. When the bond market refuses to rally on dovish Fed action, it's telling you something about structural forces the Fed cannot control. Energy stocks declined with crude oil hitting its lowest level since early 2021. Exxon and Chevron down approximately 2% each. This is supply-driven, not demand collapse. but the system treats all oil weakness as a recession signal until proven otherwise. The rotation into defensives in healthcare was mechanical, algorithmic, predictable. The crypto market's correlation with risk assets remains high, confirming digital assets are still treated as leveraged bets on global liquidity, not independent stores of value. When Japanese yields rise, the cost of maintaining carry trades increases, forcing liquidations in the most volatile, least liquid assets first. Bitcoin's decline was a liquidity event, not a fundamental one, but the system doesn't distinguish between the two in real time. Here's the Stoic interpretation and your disciplined response. The market is not broken. It's functioning exactly as designed, repricing risk in response to new information. The week's volatility wasn't chaos, it was the system's attempt to reconcile conflicting signals. Dovish Fed action, hawkish forward guidance, cooler inflation, rising long-term yields, AI enthusiasm, financing concerns. Each variable exerts force on asset prices. The equilibrium constantly shifts. The disciplined observer doesn't react to noise. We identify which forces are structural and which are transient. The AI trade isn't over, but it's maturing. The indiscriminate buying of anything labeled AI has ended. Micron's surge and Oracle's decline aren't contradictory. They're the market differentiating between companies with durable competitive advantages and those riding narrative momentum. The system rewards tangible revenue growth, margin expansion, and return on invested capital. Everything else faces multiple compression. The yen carry trade unwind is structural, not tactical. This isn't a one-week event, but a multi-quarter process. The system will adapt by reducing leverage, repricing risk assets, and reallocating capital to strategies that don't depend on cheap yen funding. Crypto's sensitivity to this dynamic exposes its continued dependence on fiat liquidity, not independence from it. The sector rotation from growth to value, mega-cap tech to small caps, isn't a regime change. It's tactical adjustment. The system is testing whether leadership can broaden beyond the Magnificent Seven. The answer depends on whether earnings growth can expand beyond technology and whether the economic cycle can sustain itself without further monetary easing. The process remains paramount. Monitor liquidity conditions, earnings revisions, and technical levels without attachment to directional bias. The market tells you what it wants through price action, volume, and breadth. This week's narrow breadth, 1715 new highs versus 3021 new lows on the NASDAQ, signals internal weakness despite index-level stability. Not healthy market structure, but not collapsing either. A market in transition, searching for the next catalyst. The anti-fragile position benefits from volatility rather than being destroyed by it. Maintain exposure to quality businesses with pricing power, durable moats, and balance sheet strength. Avoid over-leveraged positions in momentum names that depend on narrative continuation. The system rewards patience and punishes impatience. This week's whipsaw moves were attacks on those who traded every headline. The disciplined observer waits for clarity, not certainty, because certainty never arrives before the move is over. If you value systematic thinking over emotional reactions, if you want to understand how human psychology creates exploitable market patterns rather than getting swept up in the daily noise, then subscribe to this channel. In the description below, you'll find a link to download my complete framework, the same 3-layer analysis system I use to identify opportunities while others see only confusion. The market rewards those who think in systems, not stories.